Welcome to the Big Mike Fun Podcast, where you learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in. Because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fun Podcast. I'm the Big Mike Zlatnik. Today it is my pleasure and a privilege to welcome Fuquan Bilal. Hi, Fuquan.
Hey, what's going on, Mike? Thanks for having me on the podcast. I appreciate it.
Thank you very much for coming on the podcast. Fuquan is a good friend. We are in a couple of masterminds together, the Collective Genius and the Freedom Founders. He's a super, super bright guy. He lives in the neighboring state, New Jersey.
Yes.
So, tell us a little bit about you, Fuquan, your family, kids, cats, dogs, I don't know, other pets.
All right, no cats and dogs. When I was a kid, I had a dog. I had a cat named Mousy. Fun.
All right. I mean, as long as the cat didn't mind being called that.
So yeah, I have two kids, a 17-year-old, 12-year-old, and I'm a single dad actually. And I live in Livingston, New Jersey, but my office is in Clifton, New Jersey. I've been investing in New Jersey for the last 20 years. Doing fix and flips and rentals, primarily in 5 counties, and I like it. It gives me my feeling of importance to know that I can go in a community where I'm from. I'm from North New Jersey, and have the ability to revitalize the area and put these dilapidated properties back on the tax roll. So I love real estate. I'm excited about it, and I'll also do some notes. So we'll talk a little bit about that.
Yeah, that's what I was going to say. I've known you as the note specialist. You're running a distressed notes fund, right?
Absolutely. So in 2011, after the market crashed, and I kind of pivoted over to short sales, and then in 2011, I discovered the wonderful world of notes. And to me, still to this day, is the best investment strategy in the universe, I believe, because you can do it from your laptop, cell phone. And again, it's impact investing. So you're able to help homeowners stay in their house, and essentially you become the bank. So that's what I liked about it. It's another area where I was able to help people and make profit. So, I created a fund in 2013, and the fund originally was strictly for notes. And actually my first 3 funds that I did was all notes, and the fund that I'm running now currently is a hybrid model of real property and notes. And it played a really important role, under the current circumstances, to have that hybrid flexibility and have different assets in the fund where you can derive income from performing notes, from selling notes, from cash flow from rent, and also cash injections from fix and flips. So I kind of like the hybrid strategy.
That makes sense. I mean, we have a mixed fund too, Tempo Opportunity Fund. Sometimes this mixed strategy doesn't work as well. Sometimes it does. I can tell you that. I don't know if you've experienced this. And I don't know if you have any growth projects. If you have only rental properties and they're generating good cash flow, then it's probably not as much of a concern. But we mix up value add projects that generate effectively yield drag. If you invest in construction, most sponsors or most operators write it off in the current year if they're allowed to, as much as they can. I don't know if you have this issue where you buy properties, you renovate them, and you have to basically show a paper loss on a property. Because you're writing off the construction, and then that gets offset against the other income from the notes. Just curious if you've seen this issue in your fund or not. It's not a unique issue, but it is a potential issue to mix strategy when you're mixing notes with equity investments, and equity investments have a value add or renovation component to it.
Yeah, so the buy and hold stuff is light renovation work. Like we won't go in and do $100,000 renovation project on something we're going to rent. So it's light rehab stuff, and most of the time it already has cash flow in place, and we're just going and doing improvements, exterior stuff. We just took down a property and we're just cleaning it up while we're still generating income. On the other side, the flips, those are affordable homes, and these are projects that again are not large renovation projects that's going to drag, and cause yield drag. So we kind of try to stay away from that. We look at an accelerated model because we don't want to have yield drag and go to that scenario that you discussed. So yeah, we want to always have liquidity in our fund so we can take advantage of any opportunity that's out there. So we try not to deploy capital on projects that we think that's going to take long and not give us the opportunity to take advantage of other, stuff. So
Makes sense. Just curious, what kind of returns have you been generating to your investors?
but it's fun.
Yeah, for this
Yeah.
fund, yeah.
Yeah. So this fund, actually, we just launched this fund in December. And it was really challenging because of, what we went through in the beginning of the year, and trying to really, find opportunities and make it happen was a bit tough, but we still did it. I mean, in this fund, we're generating right now close to 11% on the fund level, which is not bad given the first quarter that we went through when everything pretty much slowed down and almost came to a halt. We were fortunate, though, that the rentals that we have in our fund are government backed. So we have programs with Section 8, battered women and children. So those checks kept coming in. The small portion of delinquencies that we did see were from people who lost their job, but most of those guys got back on track and we worked something out with them. Even if they're on unemployment now, we kind of rework the rent so they can continue to pay. But we were very fortunate. On the performing side, we thought we were going to see a major impact on the loans going delinquent, but we had less than, I would say, 3% of or something. The last time I checked, which was May 15th, a month ago almost, they're still paying. So we haven't really been that affected, but we're doing close to 11% on a fund level. So that's that for the first quarter.
So great results given the circumstances, the COVID environment for sure, and now Section 8 and any kind of government subsidies, music to my ears today. People love this stuff. Before, it's like, oh, Section 8, little rough neighborhood.
I know.
Listen, it's a community redevelopment opportunity. You're helping the folks in the community, and at the same time, it's safe. I mean, the government writes you a check. It feels a whole lot better than versus, a traditional rental where if somebody gets unemployed. Although now they've been getting fat checks from the government. I don't know how long it's going to continue, but
yeah, we're all in the same boat. I think that the big stigma behind Section 8 and low income housing, government-backed programs were that the quality of the people wasn't thought of as the ideal tenant. But there's some good people who's getting assistance. And you have some people who they pay a portion of the rent and then the government pay a portion. They actually work. So just really vetting the tenant, whether they're 100% government backed or not, is key in making sure that you have the right tenant in place. If they're keeping the property clean, if they, helping instead of destroying. So that's some of the stuff that we look for when we, rent our units.
I think it's a great management work. Whoever, do you self-manage or do you start?
Absolutely.
So you self-manage?
Yeah, I mean, in my 20-year experience, I have not found, and I know they're out there, I haven't found a company that would do the things that I would like to do the way that I would do it. From managing my own real estate, from my personal portfolio when I first started and dealing with tenants and everything. We've tried, but we haven't found a company that can execute, have great response time, pay bills on time and efficiently. So, we manage capital from investors and we need to make sure that these mortgages get paid and everything else. Because we have leverage in the fund as well. It's a debt fund, so it's IRA friendly. There's no UBIT. But, we haven't found a property management company that will be able to step up to the task that we have as yet. Hopefully one day we will, but until then we will self-manage.
These are the words of a wise man. All I'm going to say is that my observation is very similar. I'm here in New York, and in my investments outside of New York, it's the same observation. You tolerate them. But best case scenario, you get a semi-decent manager. During some initial period of time, they do okay job. And after a while, they either get lazy, they get corrupt, or a combination of the above, and then they start milk you with fees. And at times, it's really hard unless you start checking the manager. It becomes a complicated, a difficult challenge. So property management generally is a tough business, and I can tell you that there are a lot of the management companies' incentives is repairs, and then they send the contracts to their bodies, and then they effectively overcharge for the repair work. That is the common theme. I'm not saying anything other than it's human nature, and that's the business. The fees they collect generally for the management is not enough to them. So this is my observation. If they didn't have other opportunities, they wouldn't be in the management business. So I don't know. It's a little one-sided statement, but it's just hard. Or they just get sloppy. There's companies who, if you want good service, it's going to cost you a little more than the management fees. These repair contracts will be, or repair situations will cost you more than they should. That's why self-management, if you can, is the most optimal way to manage them and to get better return. So I don't know if you have any comments.
Yeah, it's really not that challenging if you have the right tools and systems in place, right? We use that fully. We leverage VAs, virtual assistants, to kind of manage their process. We have Podio as well to automate a lot of the workflows. Whether it's telling the tenant happy birthday, whether it's reminding them for bulk trash days, whatever it is, it's all automated. So you can spend the time, which is really the most challenging thing, is spending the time putting it all together, right? And then it's just improving it to make it better. But if you set up, systems and processes, it makes it easier to manage data than manage people. And then, as you mentioned, the biggest challenge is the repairs, making sure that they're done at a cost where it's not digging into your profit. So, if you can get all that on the wraps, like I don't have all the answers. I mean, I've been doing this 20 years. I'm still learning stuff. If you can get that under control, it can be very, very profitable for you, especially the areas where we're investing at. These are C+, B class areas, cap rates between, 8 and 9%. Typically what I'm seeing now, it's somewhere between 350 to 500 per door. And we usually would go, if we get a property that's worth 350,000, maybe we're into it for about 260, 275 a max. So we have 50,000 plus in equity, plus somewhere between 350 to 500 per door. That's our buy box. We've been pretty consistent with that. It's a lower end area, but we have the equity there. If we need to recapitalize and pay the investor back and lower the cost of capital, because we pay our investors 10% and we get money from the secondary market somewhere around 6%. So a lot of the times we will refinance out, pay off an investor, we have a cash call, and pretty much go from there.
That makes sense. So your model, just to be clear, you acquire, whether you go in the fund or just into your own portfolio, you renovate, you create some sweat equity effectively through the work. And then the cap rate is, these are pretty good cap rates. I know New Jersey has a whole lot better cap rates, higher cap rates than New York. But 8-9 cap rates is not bad. And these properties, what's the typical price? Is it single family or multifamily?
These are multifamily. These are all multifamilies, 3 families. Some of them are 2 families. And the purchase price the ARV is somewhere between 315, 350, somewhere around there. A lot of these properties, like I have one now, I give you, is a 2-family I just purchased for 120,000. It's 80,000 renovation. It's worth 315.
So 200 all in and 315 is the value.
Yeah, yep.
Oh, it's great. You're creating a third of a value. Yeah, you can refi, probably get all the money out, whatever you put in.
So, and I did that one. That one is not in the fund. That's one I did with an investor who they do a lot of real estate. I have sidecar deals that I do if I've taken down a portfolio. If it's not in the fund, I typically try to look for 3 families and above. So if I do find an opportunity that's a 2-family, but it still has good equity and good cash flow, then that'd be a one-off deal I'll do with an investor. They'll put up the money and then, I'll refinance it out, pay the money back, and pretty much go from there. So we do have those situations, but it's all in C plus B class areas, No,
it makes sense. The fact that they are, these prices are, I would imagine that have to be, worse areas, like a C minus, but the C plus B range, it's not bad at all.
This area is coming together. This is one particular area we're talking about is the east ward of a town that I buy a lot of tax liens. And, 5 years ago, no one wanted to invest here. Now everyone is running, door knocking and everything, because there's not that much opportunity in Newark, and the opportunity that's there, you'll find the same property for 400,000. When you can buy, something cheaper, it has the same cash flow, and the area is becoming, it's better now. A lot of the blighted properties are being renovated now, so it's not that much. People are not looking down on the area anymore because it's more New York-based tenants. We're taking all the guys from New York coming in, Mike.
Yeah, I was going to say now.
Brooklyn and the Bronx for the cheaper rents over here. That's increasing our rents. I used to get $900 for a 2-bedroom 3 years ago. Right now, I get $1,400. 3 years later, I'm able to get $1,400 for a 2-bedroom because of the migration we have coming from New York. And that's nothing to a New Yorker. $1,400 for a 2-bedroom. I mean, nice. Washer, dryer, cable ready. I put cable in here, alarm system, everything.
Well, I concur with you. It's the big city effect. And now with a post-COVID environment, people want space. They do want to get away from the city, but be within the, I guess, commutable distance if they have to come in. So what's interesting, this is now we're talking about fundamental shifts in trends, future trends. So we're speculating, but there's been a lot of theory that people will try to gravitate to suburbs, or not close suburbs, like half an hour from New York, but more of an hour and a half. If they can telecommute 3-4 days out of a week, then they're in great shape. If it's a blue collar workers, not intellectual property workers, then they still have to commute depending where the jobs are. So it'll come down, in my opinion, if the area is nice, and people can telecommute, you can go anywhere. Not 1,000 miles away, but an hour and a half away. Years ago, I used to work in Manhattan and lived in Plainsboro, New Jersey. Well, this is a long time ago. Well, my wife went to school in Philadelphia for her optometry degree. We lived half the way in the Plainsboro, New Jersey. And this was, not a close commute. And then I knew people who were even further out. They had an almost 2-hour commute, but they only came into the city twice a week. The rest, they work from home. This is software development, technology people, right? But if you're dealing with blue-collar work, that is a different conversation. They have to go to work. They have to be physically there. And that's where the question is going to be how commutable it is. But the substitution effect is absolutely true. Same thing happens here in Brooklyn. There's a continuous, as people don't want to pay Manhattan rents, then they gravitate to Brooklyn and Bronx and Queens and New Jersey. And the higher the rents get in the city, the affordability gets worse, the more attractive your product is, because it all comes down to affordability. What kind of money people can make and what they can afford. And in the New York area, as you know, one of the highest expenses is the rent. That's by far number one. I don't know exactly, but from what I've heard, various ranges, rents take anywhere between half to 70%. Well, not just the rent, but the utilities and everything in. 50 to 70% of the budget goes to rent, and it is a significant expense. It's a big deal. So people are sensitive.
Yeah, well, I've been successful also with some of the high-end flips that I was doing from buyers coming in from New York in droves. So I've had great opportunities with high-end flips there. We kind of pivoted now to more affordable homes. I put two on the market actually last week Thursday. By Monday, I had 6 to 8 offers on each, and Tuesday they were under contract.
Affordable range or high range?
Affordable range. One was listed for $215. I got an offer and accepted for $232. 17 over list.
Over the asking price. Yeah.
Over the asking price. The other was $245. I accepted the offer for $260. 15 over asking price. So that's really a hot market now. And we pivoted from buying the high-end stuff to more of the affordable stuff. Easy Home Depot, Lowe's product. No high-end restoration hardware or stuff that you had to design, easier 1, 2, 3, no special delivery. So we're pivoting to that. And we're enjoying that now, and we see a lot of opportunity is going to come in that space to come because it's first-time home buyer, FHA, easy to qualify. You don't have to worry about putting 20% down. go into the unknown. So we're focusing on that. And with the notes, as you know, I'm a seconds guy. We buy a lot of seconds. We buy first also. We invest in seconds that start off with second mortgages. I think it's a really great investment if you know how to manage it. It's more work than first. The strategy there is to get the homeowner to pay and not take the property. So we see them paying their first, and basically they're not paying a second, but their rent where they live at is in line with what we're asking for our second mortgage plus their first. There's a high probability we're going to work something out because no one lose a house and relocate.
Emotional equity. If they're paying the first,
there you go.
And they like the house, you have a decent chance of getting them to reperform on your second. They might have forgotten the old line of credit that they've given up a long time ago, and now, hey, they're still living on your property. You still you borrowed that money, and it's you should pay.
Yeah.
But it is emotional equity plus some real equity. As properties have appreciated, there's real equity behind it, and you have a better chance of getting them to reperform. Of course, you don't want a foreclosure.
Yeah, we mitigate risk through that by buying pools. I mean, if you buy onesie, twosie, it's risky. But if you're buying pools, 300 notes at a time plus or 100 plus notes at a time, then it works out for you. And then sometimes your losses become your gains, if you know what I mean. If you get a big payoff and then you get wiped out from foreclosure, bankruptcy, or another loan, your losses pretty much offset your gains in that part of it. So that space as well.
Yeah, we talked about this. We should probably restart this conversation because I spoke a while back to Eddie Speed. Obviously, Eddie. And it's always been a challenge to me how to invest in these small notes. We like investing in big notes. Here in New York City, distressed commercial debt, we actually like that stuff. Generally only first. But the challenge has been with the small seconds is that it's exactly that. You have to buy a pool, you have to buy a package, and you have to diversify the risk among many assets and then return on time. So it's almost like if I write you a check and you're running a fund or you're running a portfolio, it comes down to, does your return on time good enough? And is my return on investment for providing the capital good enough? And if you're taking the money from investors, the same exercise. How much total return you can get on that pool? Again, one-offs agreed that's not the approach at all. But on the pool, and is it worth your return on time? I don't know if you've done that analysis. We talked about this a while back.
Yeah.
So any good thoughts, right? If you write $1 million check and you buy a pool of 20 notes at 50,000 each, just for sake of the argument, okay? And you work it through your process, what kind of IRR can investors expect? And on the portfolio level, before you start splitting, how much is sweat worth and how much is money worth?
Yeah, on a portfolio level with seconds, we're tracking high teens, somewhere low 20s return on the pool itself. Then it's not accounting all the expenses. That's just foreclosure costs, everything else. Nothing to do with my operating expenses, my rent, payroll, anything else. We have asset managers that we calculate those costs in there as well. Those some of the cogs that we attribute to that. We've had 18%. When I first got started, the returns were 26%, but now it has increased, and vendors are more expensive now. And we leverage a lot of stuff. We used to do a lot of stuff in-house. So I had a lot of payroll and a lot of stuff. Now we outsource our custodian to do file audits. We have our services. We used to in-house service back in 2012 when I started, buying pools and started the fund to buy notes. Now we have services that we leverage. We have asset managers. So we deal with a lot of vendors that we leverage to cut a lot of that cost. And again, that's another opportunity for us to manage data. So our time is not so much involved in all of the hands-on process that go into place with that. Because it is a lot of work, but it's very profitable. And it gives you an option on a property that's worth more versus buying. You guys buy big $1 million, $2 million first mortgages, whereas somebody like Eddie and those guys, they buy a low balance first, where it's $60,000, $100,000, but it's a first mortgage. We can buy seconds, the same unpaid principal balance amount, but cheaper because it's in second. And it gives us an option on a property that's worth more. So again, our goal is not to take the property, is to work it out. So it may take 3 months, 6 months, 2 years to work it out. But again, we're leveraging vendors. Not pretty much the only time we have in-house is managing the data and following up with the vendors. So over the years, for me, it was able to evolve from being a lot of work to just really systems and processes and managing vendors and follow-ups and really helping us to increase returns. Pricing has increased because a lot of people, even the big hedge funds from the first mortgage space, because they have cheaper capital, we started to see them come into our space and buy, $10 million pools, and they don't sell it. They give it to a collection agency to work it out, let it go for 2-3 years, and whatever didn't work out, they liquidate the pool and sell it. So that's created a lot of competition for us, which,
I great comments, and it's as market matured and as the prices increased, the efficiency has to increase. If you don't get your automation efficiency, you die. You can't survive in that because the returns are lower, and unless you can better use the time, it's not profitable business. So, but great points, and I am really glad to hear you're very successful. Let's chat some more. Just hold on. I gotta do the next call. I apologize. So let's wrap up very quickly. How people find you?
Oh, sure. It's F Bilal, Bilal at nngcapitalfund.com. You can go to our site, check us out, nngcapitalfund.com.
Thank you, Fuquan. It was a pleasure to have you. I have to run to the next call.
Appreciate it.
Love to have you again. Thank you. Have a great day.
All right, Mike.
Ciao.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to bigmikefund.com or visit Amazon and type Mike Zlotnick. Keep listening and keep investing Big Mike style. See you on the next episode.